Good morning, everyone, and happy and healthy holidays. Welcome to Founders Q&A with Anthony Millin. My name is Lisa Friedlander, and Next, powered by Shulman Rogers, is really excited to offer this monthly session for entrepreneurs to come and ask me anything of the burning questions that you deal with on an everyday basis. I'd like to introduce Anthony Millin, who is the founder and co-chair of Next, serial entrepreneur, venture partner, and he is here to answer all of your burning questions. So without further ado, Anthony, I will turn it over to you to further introduce Next and take our first question.
Great. So Next is an innovative new model for delivering legal services for startup and emerging growth companies, from seed and kind of early days all the way through exit. So we become a partner as you grow and scale your business. We offer, for seed through Series A, predictable fixed price packages so that you can plan and budget for building your company. We have very high level customer service, a 3-tier customer service model. And we also integrate a lot of technology to make things much more collaborative, much more efficient, much more transparent. And we're very committed to the startup ecosystem. So we have a marketplace of like-minded service providers in areas like accounting and insurance and 409A valuations, a broad range banking, who are people who you can reach out to and connect with in an efficient way. And Lisa mentioned Startup U, which is our educational platform. So we do a lot to help develop and grow the startup ecosystem. And we're very happy to be able to offer this session today and welcome questions.
Feel free to unmute and chime in or add your question to the chat if you're more comfortable.
Sure, I'll ask a question.
Thanks, Seth.
Hi, Anthony. So we have we've used some folks to assist us with some engineering and structured the compensation, such as there's a cash piece which is contingent upon future fundraising, but there's also an equity piece of it. And I want to make sure that in providing the equity to these folks, we don't trigger any adverse tax complications for them. The amount is set. I mean, they may earn some more in the future, but the timing's pretty flexible. It's a pretty informal agreement. But I do want to avoid them getting any kind of immediate tax hit. So I wondered about your thoughts on that in terms of our structure. So we're an LLC, and so you know, we're fairly flexible. It's just the founders at this point in terms of who holds the equity.
Right. So in an LLC, I mean, one of the things you're looking at is there is a value to their services because you're paying them for a cash component. So you are correct to think about the fact that you don't want to trigger a taxable income scenario to them. If they, let's just say they were providing $10,000 worth of services and they're getting $5,000 in cash and $5,000 in equity, that $5,000 in equity is still income. And so there are ways in an LLC, and you want to get some legal counsel for that one, because there's something called, if they're getting equity, there's profit interest units or profit interests where you can set a certain price that takes into account you can kind of set it up through profit interest units or through unit appreciation rights, depending on the price that they have to pay, where you can do something, but do something to try to manage around tax issues, or you can deal with warrants and other types of equity structures instead of equity today. But definitely an issue you need to be aware of, and but one that you can work with somebody to structure through. Okay. But the key is going to be around profit interest units or unit appreciation rights or warrants. you'll kind of, those are the different types of instruments you would look at.
Okay, thank you.
Thanks, Seth. Anthony, in the chat, Candace has a number of questions around using a safe and valuation caps. What's a reasonable valuation cap and discount to set for entrepreneurs? We see
Sure.
a lot of standard terms.
So let me, in terms of a safe, just to kind of talk through the safe instrument. So a safe is a security that is used very often for the seed and pre-seed rounds. And unlike a convertible note, which is another instrument that's used very frequently in these seed and rounds, you don't have in a safe, you don't have a maturity date and you don't have an interest rate, but you do have a cap, and you usually have a cap and a discount. And particularly in the market that we're entering into, you would typically see both a cap and a discount. And the way a safe works is that the investor invests today. Let's just say they invest in your company at a $10 million cap and a 20% discount. Then what happens is when you do your next round, which is usually a priced round or a preferred stock price round, they would convert the amount. Let's just say they invested $500,000. They would convert that $500,000 at either the $10 million cap or at a 20% discount, whichever is more favorable to them. And so the reason for the cap is if you suddenly have a phenomenal year or 18 months and you go out to raise money at a $20 million valuation, if you didn't have a cap, the investors would come in at a 20% discount to that $20 million valuation or $16 million. By having the cap, they get to come in at 10 million. But if you didn't have a great 18 months and you only raised money at $5 million valuation, they get to come in at a 20% discount to that 5, which would be $4 million valuation rather than the $10 million cap. So that's kind of how the investor is protected in a safe scenario. There are more terms that are being negotiated into safes. It used to be a very, very simple instrument, but some investors now are starting to want to have, if you suddenly generate so much cash, you never do a preferred round, what happens to the safe kind of questions. And so you're seeing some investors now that the market has turned and become more of an investor in the pendulum of who has more leverage. We've kind of gone from an entrepreneur having all of the leverage to investors having more of the leverage. So we're seeing some investors coming back with safes now saying it's fine to not have the maturity date and it's fine not to have the interest rate, but if you issue dividends because you're generating so much cash, we want to participate in the dividends. And if after 18 months or 2 years, we want to have an option to convert at the valuation cap, even if you haven't had a qualified event. So we are seeing that. And then we're also seeing side letters negotiated where investors are getting pro rata rights or the right to participate in the next round based on the percentage of what they would own if the safe converted. We're seeing information rights, which are rights to information like financial statements on a quarterly basis, for instance. And we're seeing, those are two very common rights. If a safe holder is putting in a lot of money, we're seeing board observer rights as well, where they're not getting a board seat, but they're getting the ability to attend board meetings and have access to board documents. And in terms of the amount of the cap and what your cap should be, it really depends on the business. So in these early stages, the things that you're looking at are what is the team? How qualified, how experienced, how much depth and domain expertise do they have in the area? Do they have prior companies under their belt so they've got a track record? You're looking at, is there any traction in the business? Do you have a minimum viable product? Do you have some first mover customers? You're looking at how big is this opportunity? If this entrepreneur executes in this market, is this a business that can be 50 million, 500 million, 2 billion? How big is the opportunity? And so you're looking at those are really the only pieces of information you often have to go on. And so then you look at a valuation cap that takes into account the level of risk and how much it's de-risked from an execution point of view with the team, product market fit point of view, and a market size. And then you also have to look at if there's any other companies that you know of that are similar, and remembering that the investor does have some downside protection with the 20% discount, so that you often have the ability to have a higher cap than you would if it was a priced round. So those are a lot of points. I don't know if you have any other questions specifically to say.
Yeah, there was one other piece in there, and all great questions, Candace, about sort of the number of investors that you can have on a SAFE. Is there a rule of thumb? I know we've seen companies use SAFEs way longer than what was originally potentially anticipated. 3 million, $5 million raises on SAFEs. Is there a risk or that future investors, are there too many? Is there a point where you have too many investors on a SAFE?
I mean, the more investors you have in a SAFE, just the more complex your cap table, and if people have information rights or they have preemptive rights to everybody, it adds complexity. But I don't think, unless you're getting up into numbers where you're running into security law issues, that's too much of a concern. If you have a lot of people, family members who are coming in, they could, and you've got a number of friends and family, you could not have so many friends and family on the cap table, use a SPV, a special purpose vehicle, where they all go into the SPV. So you only have one person for that group of family members on the cap table. But we see a number of investors coming in to SAFE rounds, and we, like Lisa just said, we see large SAFE rounds. It will be interesting to see as the markets continue to evolve, to see if for these larger rounds, investors are still comfortable with SAFEs or want some sort of adjustment to the SAFE language or want to move to a convertible note. We'll see over the next 12 to 18, 24 months how that changes. But we're coming out of a market where we did multi-million-dollar SAFEs with many investors, and also we saw multiple series of SAFEs. So somebody would do a SAFE round and raise $1 million or $750,000, and then they just wouldn't get far enough in their growth to get to an A round. So suddenly they needed 1.5, but they really were not at a point of revenue and traction to get to an A round. So they would do another SAFE, but maybe this time it would be 1.5 million, a series 2 SAFE, but at a higher cap. So their first cap was at 5 million and the second cap's at 10 million. And then we've even seen people do series 3 and series 4 SAFEs to bridge between a series A round. And the more SAFEs you have at different caps and valuations, you have a more complex cap table, but then everyone converts into preferred stock when you do your qualified financing round.
Right. Great. And then Candace also had a question that I chimed in the chat, and get your sense too in terms of what's a minimum investment amount on a SAFE. For me, in our angel group, we typically see companies raising anywhere from 500,000 to 3 million. And more often than not, the minimum check size is 25K, 35K, somewhere between 25 and 50K as a minimum investment amount at that pre-seed seed. Anthony, do you agree? Have you seen larger, smaller check size minimums?
You know,
Again, I guess that's where the SPV comes in. Sorry, you
yeah, and also when you're getting ready to raise, you look at how much you need to kind of de-risk your company to get to the next raise. So, you know, we've seen people initially have somebody who's looking to put in 100,000. And they ask us, you know, 150,000, and they'll say, what security should we use for this friends and family investor who wants to put in, they've got 3 investors, each want to put in 50. And the safe is a good instrument for that because it's not as complex a set of documents as preferred stock or convertible notes. So if you're looking to bring in money, you're either coming into common stock for these early small amounts of money, but then you still have to kind of price it, and then you end up pricing your common stock, or much more frequently, you come into a safe. So we've done small safes as small as 100,000 in $20,000 and $25,000 increments. The key is you want the investors to be accredited investors, and so an accredited investor is an important component under the security regulations in terms of the disclosures and the documentation that you need. And so it's, you know, somebody who has a net, their net worth of at least $1 million, not including their principal residence. And you also have, or you have $200,000 in income, or with a partner $300,000 in income over 2 years, for each of the last 2 years. So there are different tests that you look at, but you do want to try to restrict your raises to accredited investors.
Thank you, Anthony. Candace, I hope that answered most, if not all of your questions. Feel free to reach out to us after the fact. Kunal has a good question about a down round. This is always an interesting approach and troublesome for founders for sure. What is the etiquette in terms of if you have to do a down round from your first, how do you handle your initial investor, your first angel or friend and family that came in early, and then your next raise, you have to do a down round?
So it depends on what security they came in on. So let's just say you had a bunch of friends and family and you had a $4 million cap on a safe. And then you do another safe a year later, but the market has changed and it's become a much tougher market. So you do $3 million cap. So then you have a couple of choices. One is nothing happens at that moment in time. People signed a security and agreement with you at a $4 million cap and a 20% discount. When you actually go into preferred stock, everything gets priced at the caps. Some people with friends and family will go back and reprice the cap, so amend the safe so that their early friends and family investors are not paying more than later investors who took even less risk than the first investors. And sometimes the safes have something called most favored nation clauses, where MFN clauses built into them which you can put into your friends and family safe, which means that if somebody comes in later with a better cap or a better terms, they can in essence switch to that better term safe. The better terms from that safe. So nothing happens yet until you actually issue equity. But I always feel like if people come in early and take more risk and the market changes, even though legally you're not required to reprice their cap, it feels like the right thing to me to do, and particularly if it's your friends and family, right? But for everybody.
Yeah, thank you.
Kunal, does that answer all your questions? I know you had a second one in there as well about if the price round, but I think Anthony just responded to that. So I think we're good in the chat. Anybody have an additional question that we haven't heard from, or even Kunal or Candace a follow-up to Anthony's responses? We have about 10 minutes left in our session together, so love to have additional questions.
Yeah, so I'm not sure if this was directly touched upon. If we achieve profitability, because Our Love Visa is starting to see daily signups. So if we're able to achieve profitability in the next 6 months, and we don't actually have a price round, or nothing happens with the safe, what is the etiquette there? What typically?
You mean if you first issue a safe and then you become profitable?
Yes. Yeah. Correct.
Right. So that's why we're seeing some of these safes start to shift in their language, right? Because unlike a convertible note where you have a maturity event that you either have to repay the convertible note or they have a right to convert, traditionally safes were silent about this situation. And so investors have started saying, wait a second, if you become really profitable and you don't do another round, we could sit for the next 3 years or 5 years as a safe until you sell the company.
Right.
And so, so one thing is built into the language, some people are starting to put into their safes after a certain period of time, they have the right to convert at the cap.
Okay.
At the option of the investor. You could go back to your investors and say to them, it doesn't, we have become so profitable, we're not going to do another preferred round. But if you would like to, we could, you could renegotiate with them to come in at the cap.
Right. Oh, and I've also heard of people buying them back out. You can buy out your investor at a favorable price. I've seen that happen with some startups.
Yeah, you can negotiate a buyout, to buy, although, often for investors who are investing in early stage companies, they're not doing it for the interest or the 20% return.
Right.
They're doing it because this is the part of their investment strategy for going for the 10 times or 20 or 30 times return.
Right.
And they're prepared to lose that money for the chance of a big return. They don't want to take a big risk. And then as the company is becoming successful, get like 20% back.
Right. Right.
So it's often not, from the investor's perspective, although some people may want their money back, depending on how much extra they're getting on their investment will dictate whether it makes sense. But a lot of early stage investors are not going to want, as things start taking off and becoming profitable, to step out.
Right. Thank you for that. Yeah, I'll make sure that it's worth their while.
That's great. Any other questions for Anthony or comments on any of the discussion so far? Sometimes entrepreneurs have great perspectives too to add, even if it's not on the legal front. Anthony, what are some trends do you think that you're going to see in 2023 in terms of the shift in the market that we're all well aware of now, from 2021, I guess, when the valuations and everything just went crazy? What do you think 2023 is going to bring?
Yeah, I mean, we're still seeing activity, particularly in this stage of the market. I mean, we're doing deals weekly and having clients we're working with still actively raising money. We're seeing a lowering of valuations to some degree, and we're seeing terms changing, like I said, to become a little more tilting a little bit away from being so one-sided from the entrepreneur's perspective to being a little more balanced. I think traction is the key. And so, it used to be a great idea. We were in a phase where a great idea and a good team could get funded their next rounds, but people want to see product market fit. They want to see that you're solving a problem that people not only feel is an important problem to solve, but that people are prepared to pay for that solution, and they're prepared to pay for that solution in an amount that, even if not initially on it, at least, it will bring you to profitability, that you can see a line of sight to strong revenue growth and So I think that's another big trend, is revenue and traction becoming more and more important to being able to successfully raise. And so whatever you can do to kind of get to that product market fit in those early customers becomes really important, and much more so than it was a few years ago. Investors are still sitting with a lot of money on the sidelines. There were record amounts went into funds. And so there is a tremendous amount of capital, assets under management, capital under management. Just some funds are being a little bit more careful, looking a little bit longer, doing a little more due diligence before they pull the trigger and make those investments. So I think that's really, we see activity still happening for companies that are strong, for teams that are strong, for teams that are executing and getting that traction, but maybe not quite at the valuations they would have received 2 or 3 years ago.
Terrific. Thank you. Any final questions as we wrap up and send everybody off, hopefully, for a happy and safe and healthy holiday season? Any final questions? Well, thank you again for joining us. We really appreciate your time today. Follow us on LinkedIn to find out what we're doing. We always have great events, partner webinars monthly, this Founders Q&A with Anthony monthly, typically the last Friday of every month at 11 a.m., although due to the holiday, we moved it up. So please feel free to reach out. info@next.law is an easy email, and mine is lfriedlander@shulmanrogers.com. So thank you all, and we look forward to seeing you after the new year.
Great. Happy holidays, everybody. Happy and healthy New Year. Thank you.